Hello, everyone, and depending on from where you are joining us, good afternoon, good morning, Sani Bonani, Dumelang, and welcome to this Skybound Capital webinar. My name is Matthew Pierce, speaking to you from Skybound's Cape Town offices, and from where I will shortly welcome our Chief Investment Officer, Theo Shu from Hong Kong, and our Chief Investment Strategist, Jabir Sadawala from London. And for today's webinar, I'm standing in for our Group CEO, Conrad Am, who, as we speak, is on a flight back from Botswana, where he has spent the past 3 days with clients. And Conrad has asked me to pass on his thanks to you for your attendance and your interest. As specialists in private market unlisted asset management, a huge amount of our time as a business is spent researching industries, verticals, and companies to which we provide private debt, private equity, and most recently trade finance and invoice financing solutions. And overlaying that detailed research is as comprehensive as possible an understanding of the macroeconomic conditions and themes that are influencing investment decisions and strategies globally, and how those in turn influence decisions that our investment team makes. To this end, we are truly blessed to have Theo and Jabir as part of our team, two investment professionals with decades of experience across multiple markets and regions, and who are passionate about what they do and what drives investment decision making. It's fair to say that the only certain thing in the world right now seems to be uncertainty, whether it be economic, geopolitical, or otherwise, and it takes steady, wise, experienced heads to navigate these conditions. Now, this is Theo and Jabir's first quarterly View of the World webinar for 2024, and they're excited about updating you on their informed views every 3 months going forward. It's important to note that these sessions do not in any way constitute financial advice, but are presented to give you a sense of their view of the world right now, which has a bearing on the investment decisions they and our team ultimately make. If you have any questions during the course of their presentations, please put them in the chat on Teams, and time allowing, they will pick out some questions during the session. So without any further ado, I'll hand over to Jabir in London to get started.
Lovely, thanks, Matt, and good morning, good afternoon, good evening, everybody, wherever you may be. I'm just going to bring up my presentation here. This is the only bit that ever scares me, but it seems to have worked. Hopefully, if you can see that, then I will kick off. I'll just put this in proper mode. Okay, so it's an interesting comment about the only thing certain in this world is uncertainty. Because if there's one thing I've really come to try and distinguish over the years is how much of that uncertainty is just created by ourselves versus the true extent of uncertainty that really does exist in the world. And what I'm going to try and do in this presentation is just to elaborate on that, because for the most part, I think the writing is on the wall in terms of where things are going. So let's start with what I think are the factors that are really going to influence 2024. Top of the list, inflation and interest rates. And that's what this presentation is really going to be about. It's not going to be technical. It's just simply looking at this debate, this argument between inflation, interest rates, and what it's going to do in terms of impact on the markets. The two other things that one should consider, but I'm not going to delve into it in this presentation, are geopolitics. And I think pretty much everyone on the call will see what impact Russia-Ukraine has had, especially in 2022, with an absolute resurgence in inflation, which, by the way, had already been happening even before that. We had it through COVID, and even before COVID, we had it in the build-up to 2020, with demands starting to steadily outstrip supply. And there was a slow build-up in inflation. What's happened is that along the way, all these things have just become accentuated. The third thing is the election calendar. This year we've got crazy number of elections that are taking place, and they will all have an impact on how they shape the outlook. The big one that people focus on obviously will be in November in the US, but in between that, you've got Europe and what the implications are politically. That's a separate topic. I won't be going into that. So let's just look at this chart. This was something that was produced by Blackstone. And what they did was they interviewed a whole bunch of CEOs of top companies, something like 200 companies. This is all US centric. And those companies between them account for over 700,000 employees. And they were simply asked, what are you most concerned with? And top of the list, higher interest rates. Now, when I saw this, I just thought it was actually quite fascinating because you had a situation going into the end of last year where people thought there were going to be rate cuts galore this year. Depending on who you spoke to, I mean, the range that I saw was anything from about 3 cuts, which is what the Fed itself had implied, to something like 6. It could have been higher. Second on the list is slowing economic growth. I dispute that, and I'm going to come on to certain slides which will perhaps demonstrate why I think growth is going to be better than people think. And third on the list is inflation, including higher energy prices. And I think those top 3 actually say it all. Along the way, if you look at some of the others, things like the ability to hire and retain qualified workers, that's slipped down the rating a bit, but it's still high. It's number 4. Speed of technological change, and then further down, AI, again, speed of technological change in that regard. They're all on there. I think a lot of these are going to be a lot quicker than people think. But I guess if you base it on what we know today, the picture is exactly as the ranking shows there. Now, coming back to the top of the list one, higher interest rates. What's the big deal about this? Well, going into the end of last year, so we basically had this period here, the number of rate cuts that people were forecasting were quite significant. In fact, it actually started there. Sorry, I'm marking the wrong bit. If you go up here, it is quite significant. And as a result, the Treasury yield curve, this is the US government bond, started to come down quite dramatically. Then we turn into the start of this year, and all of a sudden it's reversal. Pretty much everything that people were saying at the end of last year then went into reverse. And as a result, Treasury yields began going up. And this kind of defined the uncertainty, the volatility that had been kicked up in markets. Suddenly, it wasn't 3 to 6 rate cuts. People were thinking, they're now asking, will we have any rate cuts at all this year? And those rate cuts that were expected to happen next month have all been pushed further back into May and June. Those are the latest odds. If you then look at, as I did, analyst forecasts over time, I came across this chart. And it's a lovely chart because for as long as I can remember for that period, no analyst, no pundit has ever got rate forecast predictions right. So the solid line is what rates have actually done. This is just US Fed funds rate. And the dotted lines are what the predictions were round about that time. The only time they got it right was around COVID time because of the level of uncertainty that existed in the system. That was sort of almost a given. I don't think anyone gets any extra brownie points for that. But as soon as we started to come out of that COVID era and progress, it's just been wrong ever since. It's just resumed its incorrect trend. So this is another chart courtesy of Goldman Sachs. They publish this every so often, every couple of weeks. And because of the consistency of it, it's actually becoming quite a reliable indicator because even if they're making mistakes in terms of their interpretation, those mistakes will be consistent. What this chart's doing is it's looking at what the market implied path is of Fed funds rate. So the solid line up to here is what we've actually seen in markets in terms of rate increases or rate cuts. Here, as you can see, it's been rate increases. And the blue bars tell you by how much the US Fed has actually raised rates. And we've had some hefty increases here, massive increases. And then a couple of 50s. So that's 50 is 50 basis points. So that's 0.5%. 75 is 75 basis points. That's 0.75%. And then a whole bunch of 0.25%. What this chart is now saying is if you take the current pricing of something called the Fed Fund futures rate and extrapolate backwards, and if you assume that the Fed follows that exact same path, the rate cuts we're going to see this year are as illustrated here. It's quite paltry. If you add this up, you're looking at 0.5% or so in total. It's not a lot. That's based on the Fed Fund futures implied rate. It's almost, I think of it as a sort of a betting shop. You know, the odds that they give you on what they think is going to happen on specific events. This is the market betting odds of what's going to happen with rates. It's not a lot. Not much is expected to happen. So then last week we had the Fed meeting, the post-meeting statement that the Chairman Powell delivered, and in that he came out with some key comments. The first was that he's leaving rates unchanged in the current bracket range of 5.25 to 5.5. That's high, but it's not the highest it's been. He admitted that growth has been expanding at a very solid pace. He said the risks in terms of employment and inflation goals are moving towards a better balance. And critically here, he removed the tightening bias from its statement and he replaced it with this comment. The committee does not expect it will be appropriate to reduce the target range until it has gained confidence, greater confidence. Inflation is moving sustainably towards 2%. In other words, it is not yet convinced. And that's really critical. It's a slight deviation from the past, but it's a very significant one. Then, just recently, they released the full minutes of that same press statement that he issued. And in that, he elaborated, or rather the minutes elaborated the views of Powell and other committee members. And these comments were quite distinct. In terms of interest rates, there is absolutely no hurry to cut rates. Made that very clear. On inflation, they express both optimism and caution. It might sound like sitting on the fence, but you actually, as this presentation goes on, hopefully you'll sort of see why it sounds like they're sitting on the fence. It's not because they don't know what to do. It's because there are some conflicting views out there. In terms of rate setting and the level of confidence around that, they said, no cuts would be coming until the FOMC held greater confidence that inflation was receding. In other words, they don't believe that it is receding, at least quickly enough. In terms of policy risks and data assessment, most noted the risks of moving too quickly to ease the stance of policy and emphasized the importance of carefully assessing the incoming data. In other words, we're going to be very data dependent. Their target remains 2%. They're not budging from that. Whether that's a realistic target is a whole different discussion, but they are not budging from 2%. They advocated that they want to see more, before they start doing any policy easing. And last but not least, they judged the policy rate was likely at its peak for this cycle. Those are very carefully chosen words. So it's all largely saying the same thing. We're not ready, guys. We're not convinced that inflation is going to hit 2%, or that it's going to happen anytime soon. And that's why they keep kicking the can down the road in terms of potential rate cuts. If you look at the January data, we've got a very important figure coming out today, I think, in terms of inflation. But the trend is still on the high side. It's what they mean by sticky inflation. And the one that's actually very interesting is this one. It's what they call the super core services index. Why this? Because this is the one that impacts the consumer the most. This is the one that the consumer feels the most. And that's denoted by the red line. And if you look at it on a monthly basis, give or take, it's averaging about 0.5% a month. If you annualize that, that's north of 6%. So some would say that's the real inflation rate that the consumer is feeling. This is the problem with economics and stats in general. You can slice and dice something any which way you want and come out with figures that really suit the narrative. But what affects the individual is something like this. So it hasn't gone away. Is the upshot of this? If you look at U.S. growth, I mean, it's smashing it. The consumer. This is the orange yellow bit of the bar here, has always been the most significant part of U.S. growth. In the U.S., the consumer household consumption, that's what the likes of you and I all spend. Accounts for 70% of US GDP. That's why it's a very self-sustaining economy. And everything else around it is largely to feed that. You then have government consumption, which is roughly another 10%. So you have a US economy that is pretty much 80% consumption driven. So trade, if they have big trade deficits, that's because they need to import more to feed their insatiable appetite. That picture is one still of a pretty healthy economy that is always surprised to the upside. If you look at household savings ratio, so there's going to be quite a big focus in this in terms of the consumer and how they're looking, because how the consumer's looking is going to determine the path ahead. And if you look at this, I mean, the United States, the white line, looks quite low, doesn't it? It's around 4%. But actually, don't be alarmed by that. And so too is the projection, by the way. It's out here. Don't be alarmed by that, because the US consumer is notorious for having a very diverse spread of household assets, which includes property. It includes their pension plans, the 401s. It includes their personal investments. It includes the savings. And depending on their pocket size, the income levels, the further down the income levels you go, the more they're going to take punts on things like AI stocks and Bitcoin and all that kind of stuff. And by and large, these have done very well. So they do have money, they do have wealth, and this is helping to sustain them. But look at some of these other countries here. I mean, you've got the United Kingdom. I mean, this surprised me. We're saving around 10% of our disposable incomes. There was a time when that was shockingly low. If you were to go back in time, it would actually be sub 5. I once heard a stat that the average person in the UK, if they're laid off from their work, they've barely got 3 months to survive on. So this is a big change in the picture. Germany, which is the the big engine in Europe, that too is hovering at around 10%. We're on par with Germany, and they are one of the most prudent nations out there. If you look at wages, this is another interesting picture as well. Across the 3 different regions, you're showing what wages have been doing. And overall, they've been pretty healthy. They are going up. They've been slowing down, which has helped the inflation cause, but they remain positive. But if you measure it in real terms, in other words, how much are your wages going up versus inflation? What you're looking for, what you want to see is a gap. Ideally you want to see wage growth above inflation. So that's the blue line exceeding this red or whatever color that is. And that's exactly what you're seeing. In real terms, it's positive. In real terms, in the UK, it's very positive. And in the US, it's positive. So that's a positive sign. They've got money to spend. Bear in mind that in regions like the US, for instance, the mortgage market is fixed for many, many years. And the average mortgage rate is something like, it's less than 3% on a weighted average basis. Most mortgages are fixed for 15 to 30 years. The variable rate mortgage market, which includes 1 year fixed, provided it's less than a year, is something like 3% of the market. Most people have got fixed mortgages. So their outflows, their cash flows are defined. They don't need to worry. It only becomes a concern if they have to move. And for the most part, people aren't moving. That's why the housing market is so stagnant. Manufacturing PMIs, that's a very fancy way of looking at measuring activity, economic activity around factories and production. And it's been subdued. Anything below 50 implies contraction. But what you're seeing is an uptick across all of these. So it's flat to upside. There is a change taking place, and that's evidenced just in the last 2 or 3 data points. It's starting to become a trend. And if that happens, if that continues to bear out, this is going to lift economic activity across the board. Core CPI, it's been coming down, but it remains quite sticky. This goes to the inflation point earlier. China is the lowest. They're still in deflation mode and currently exporting deflation. It's my view that this will change in time, in the time ahead. That's not going to persist for forever. And speaking of China, or sticking with China, there's been a lot of noise about it. Apparently, the economy is going to fall off a cliff. It's turning out to be a basket case, and they can't get themselves out of the mire that they're in. But for me, as an outsider looking into China, I see a very different situation. I see a situation where, as this chart depicts, this is their 1 year lending rate, which tends to define corporate lending. They also have a 5 year lending rate, which pretty much defines the mortgage market. But that was shown on here, would tell exactly the same story. The lending rates are way above inflation. Massively above. Look at that gap there. It's huge. So if they really want to stimulate the economy, as they just did recently with the 5 year rate and only the 5 year rate, they kept the 1 year lending rate exactly the same. That straight line just continues. But with the 5 year rate, they reduced it by 0.25%. And that's really to help just give the property market some support. And connected to that, the stock market is heavily correlated to the 1 year lending rate. So again, you've got very tight monetary conditions here. If they want to stimulate the market, they can do so. I don't think the Chinese regime in Beijing is in a hurry to do anything. The kind of point that people are missing was the sort of news that was announced last week, where, to my mind, China actually announced, it was one of the most significant moves, in which they introduced something called Project Whitelist, which is a lending program to property developers, both existing ones as well as those in financial trouble. And it's a very targeted policy, and it's designed to help shore up the property market. So they are addressing it, but they're doing it in a very pinpoint manner. And that's how I think the Chinese regime will continue with it. They're not going to print money for the hell of it. Final slide. Where does that leave us in terms of the world and the whole thing? Well, valuations are extremely attractive. They're very attractive. So this, courtesy again of Goldman Sachs. On the left, what you have here is a valuation metric. Don't worry about the fancy terminology, but what it's saying is that they take earnings, projected earnings on a 12-month basis, and then they see what kind of multiple these stocks are trading on. This is using the MSCI. On the left, you have the regions. US is the most expensive, the orange diamond shape. It shows it's currently about 21 times. As you come down, the world and the all-country world are heavily dominated by the US. So not surprisingly, they're fairly large. But the minute you step out of the US, look how attractive it is. Japan is still only on just over 15 times. And that's despite the massive rally they've had in Japan. It's huge. And I don't think it's going to stop. It might slow down a bit, but it's not going to stop, especially if they remove controls over interest rates, something called yield curve control. Until now, the Japanese have always limited how far yield curves can go, interest rates can go. Now they get, it looks almost certain they're going to steadily start to remove it. In Europe, it's even cheaper, 13 times. Take out Japan, and Asia is on under 13. And then you got the rest of the EM on just under 12. This is very, very cheap. And if my view that the world economy is steadily picking up holds, then money will start to flow down this line. That's the whole point. If you split this in terms of sector, look, no surprises, right? Technology is way out in front, way out in front. There are a bunch of factors. You've probably seen the fabulous 7 and the fabulous 5, the fabulous endless numbers. They are dominating this. But as you start to go down here, it starts to get very, very cheap. I think energy is going to get a big boost, and that's going to be a very attractive place to go for. So it is very much about inflation. I think inflation, we're not through the woods yet in terms of inflation. And as the world economy picks up, I think you're going to start to see inflation pick up again. So on that note, I will, I'll just come out of this and try and disconnect. Hopefully, is it back to normal now?
Yes.
Okay.
So thank you very much, Jabir. Thank you, Matt, for the intro. I'm very happy to jump right into this. Both of my colleagues have mentioned uncertainty, and Jabir talked about this significant number or crazy number of elections, and I can give you the number. So we are looking at more than 50 general elections around the world in this single year. And let's assume Jabir is becoming very, very certain on his call on Japan, that the rally will continue. Jabir is becoming 100% certain that the rally will continue. What shall we do? Shall we go all in Japanese equities or Japanese assets? Now, let me start with my session. If there's one thing and one thing only I want to drive home with today, that is dispersion. And the solution to dispersion, diversification, which many of you might regard as a cliche. I don't argue with that. There was this saying that diversification is the only free lunch in investing. Maybe we can argue whether it is true or not academically, but it is undeniable that diversification certainly adds benefits to portfolios to a certain extent. The largest challenge to diversification is human behavior. If we know that we are holding an investment that is going to be a disappointment, if we know that we actively allocate to that investment that is going to be a disappointment, and we allocate to that investment in advance as part of the plan. Now, this is becoming very difficult to stomach, right? And that is exactly the diversification I'm alluding to. Jabir and I were speaking to a few bankers recently. We provided advice to these bankers earlier, and now they're complaining. They're complaining about one specific investment. They said, this thing has done nothing in the past 2-3 years. I would have been better off just investing everything into US equities. Well, to be fair, they had US equities in the portfolio. So the investment they were complaining about is nothing to do with US equity or a public market even, or the conventional long-only strategies. But see, this is from people who are professionals, people who know exactly what diversification is, but from time to time, they keep forgetting it conveniently. And this is exactly why I am going to stress on diversification in my session. Many of you might think, oh, this is a macro session. Shouldn't we be focusing on macro? I think what's more important than macro is the issue that we need to address under or in the macro environment. And in this macro environment, we're talking about uncertainty. And the one best solution to uncertainty or to address the concern of dispersion that we're seeing in the market is diversification. Now, let me quickly give you a few examples in the public market first to explain the dispersion I talked about. Jabir used the word fabulous seven. There are also people calling them magnificent seven. It doesn't matter. But if you look at US equities for the year 2023, which is on the chart here, the blue line is, the blue line is the performance of Magnificent Seven, and the green line is the broader US market, and the gray line is US market X Magnificent Seven. Okay, and as you can see, obviously
Apologies,
in
Theo.
hindsight, if we
Apologies,
Yeah.
Theo, for interrupting. The slides are not moving, so we're still on the cover.
oh, sorry, can you see the slides now?
No,
Are they
it's still
moving now?
Still the cover.
Okay, let me stop sharing and start again. Perhaps can you see the slide now?
Yeah, we are
I'm
Magnificent
not
Seven.
maximizing it.
We're on the
Yes, sorry,
Magnificent,
apology.
okay.
Yeah, so that is right. So this is the Magnificent Seven. The blue line is the performance of Magnificent Seven. The green line is the broader US market. And then the gray line is US X Magnificent Seven. So in hindsight, we know that we should have, if we had the choice, invested all into the blue line. But no one can make that forecast at the beginning of 2023, right? So that's within the same equity market, but across different stocks. Let me show another example. Let's move on to Europe. Jabir mentioned Europe, right? So valuation of European equities are pretty low. And trust me, valuation of European banks are significantly lower. And these are two banks in one specific European country. And this is their performance last year. As you can see, the two stocks performed very similarly in the first half of the year, but then they started to diverge. At the end of the year, the gap was very, very wide. So if you happen to be investing into only one of them, you really don't know whether you will end the year in tears or end the year in joy. So those two examples are public markets, and we see the same for fixed income as well. The dispersion is huge, and it's not just among the developed markets. If you look at the DM, if you look at the EM, it's the same. Last year, what were the best performing equity markets? Turkish equities, right? Argentina equities. But there are many poor performers too, for example, Chinese equities, and we will get onto that very quickly. The dispersion is not just in the public market. We also see that a lot in the private market too. For example, private equity. Many of you might still remember in the past, we used to call many large private companies as unicorns, and unicorns get very, very popular for a long while. But in the past 2 years, what we have been seeing quite a lot is many of these companies are entering into down rounds. Down rounds meaning they are raising new equity capital, but at much lower valuation than the previous rounds. So you will note that many of them are not doing so well. But at the same time, we have companies like OpenAI, right? Okay, again, in hindsight, we know which companies became the winners, which companies became the losers. And many of our clients, our institutional clients, they are always boasting of the large team of analysts they have, and they would argue, you know what, given the tremendous amount of information that we have and the thorough due diligence and analysis that we do, we should be able to find out the companies that could potentially do better. But you know what? I suppose no one could really tell whether Altman would return to the company over that weekend. And that weekend determined whether OpenAI will still be a company or not. That is just not something that an analyst can forecast, given whichever amount of information they have access to. So then, what do we do? The jobs of Japan and myself is really to look at the market, to locate opportunity sets that are possibly increasing our winning chances. And how? By locating mega trends. So there are definitely something in the market that we know that will likely to do better. For example, impact investing, or for example, zero emission. Do we know exactly which company is going to perform better? Maybe not, but we do know that by investing into those mega trends, one possibly can increase their winning chances. And similarly, in the private market, we see mega trends too. For example, here, I'm talking about banks that are withdrawing. We're looking at a 1.5 trillion business. What is that? That is the total fund AUM of private credit. And on this chart, you're looking at the past 20 years when the industry's AUM increased from roughly 100 billion to 1.5 trillion dollar. And then many investors will question, was it really just because we were in a specific rate cycle? Not really. Let me overlay this with the benchmark rate. So here I'm overlaying it with the Fed fund rate for US dollar. So as you can see that actually we experienced rate hikes and rate cuts during the whole period. But that trend continued. Pace might be different from one year to another, but the trend remained upward. And that trend remained upward because we had a lot of disruptions going on in the banking industry that directly lead to this mega trend that we see in private credit. So if we look at this chart, you have the blue bars that indicate the market share of bank loans and the green bars for non-bank lenders. And as you can see, over the past 15, 14 years, the blue bars are shrinking and the green bars are expanding. I overlay this on the top with a few bubbles, and those bubbles are the key regulatory measures that we see in the market that significantly change the banking industry. So right after GFC, we had Dodd-Frank, and then in the early 2010s, you have the introduction of Basel III, although you can argue that even till today, it hasn't been fully implemented or introduced. But now we are already looking at a whole set of new standards of Basel III. And all those contributed to the big shrinkage of banking market share in the lending markets. Of course, it's not just the regulations. The banks sometimes are doing it on purpose or making their active moves. Many of you might still remember the mini banking crisis at the beginning of 2022. Last year, the beginning of last year, when Silicon Valley Bank went bankrupt, right? So soon afterwards, as you can see, the US banks have been withdrawing from loan origination across all these different segments within lending. So this has been a big theme that banks are getting out of financing corporates or individuals. And the non-bank lenders, the private lending, the private credit managers are stepping in to take over their market share. So here is a biased survey. I'm calling it biased because it is coming from a private credit manager, a private market manager, KKR. So KKR did a survey recently to the family offices and high net worth individuals, asking them where do they see opportunities to increase allocation in year 2024. The majority of the respondents attributed their future allocation to private credit. That's the 45% that you see. Again, in private market, we also require diversification. In the market, you see many managers, be it private credit or private equity, that will be focusing on a specific geographic region, specific segment of the market. There will always be opportunities here and there, but we strongly suggest our investors, when they are building up their private market portfolio, they should be looking at diversification. Diversification across sectors, across asset classes, across different geographic regions as well. Now, given that I'm based in Hong Kong, I need to talk a little bit about China, though Jabir has touched on it a little. But I'll focus on the dispersion and opportunities that I just mentioned. As I said, Chinese markets, Chinese equities performed particularly poorly last year. That was the general impression of investors. But was it really true, or was it always the case? Now, on this chart, I'm comparing two markets. From November 2022 to early December 2023, a span of about 13 months. And as you can see, the two markets performed differently throughout the period, but they ended in roughly the same place. And the two markets, the blue line was Chinese equity, and the purple line was US equity. So throughout a period from November 22 to November, the end of November 23, basically, the two markets actually delivered identical returns. Okay, it's all about the period that you choose. It's all about timing the market. When do you get into that market? But can any investor time the market perfectly? I don't think so. So now I move the time spent only by a little. When I say a little, I postpone the whole period by 1 to 2 months. So this chart is looking at year 2023, the whole calendar year, from Jan to end December 2023. The same two markets, purple, blue. Purple being US equity, blue being Chinese equity. And here are the performance of the year. US equities did 24% in the year, and while Chinese equities lost 11%. So what I'm saying is, if the investors saw the tremendous performance, positive performance of Chinese equities half a year earlier, and then decided, you know what, let's jump on that bandwagon. That should be the winning recipe. And then half a year later, they will really be disappointed. But that trend, that gap you see on this chart is not necessarily going to widen further. Do we know which direction it is heading? Is it going to expand or is it going to narrow? We don't. And that's why diversification matters. Jabir briefly touched on geopolitical tension and the policies that we see coming out of this government, that government. Focus has been on Middle East. Focus has been on Ukraine. Not a lot of people are noticing this recent incidents taking place in the Taiwan Strait. So the Taiwanese Coast Guard basically turned over a Chinese fishing boat, killing 2 fishermen, which has escalated to a much larger event now. So this took place about 2 weeks ago. Can this be a trigger point for something more drastic? Maybe, maybe not. I will bet 95% plus not. But all these events are contributing to the uncertainty my colleagues mentioned earlier in the presentation. And that uncertainty is going to lead to further dispersion. But remember, I mentioned that Turkish equities, Argentina equities, Russian equities were doing very well. What I'm trying to say is, even a disastrous event might not lead to disastrous performance of assets in that market. Okay, so during the same period since the event to today, Chinese equities are up more than 10% just in the past 2 weeks. Now, let me end with a relatively light note. You might remember Jabir mentioned China exporting deflation. Let me show you the numbers on the left. So if we look at net export, what is China exporting and what is Hong Kong exporting? So there are two bars here on the left. These bars are total number of visits from Hong Kong to China and China to Hong Kong. So the longer bar is the number of visits of Hong Kong residents to mainland China in year 2023, and that is 53 million visits. And the visits from China to Hong Kong during the same period was 26 million. Now, let me give you the context. Hong Kong has a population of 7 million. That 7 million people paid 53 million visits to China in 1 year, on average 7 to 8 times per head. And China has a population of 1.4 billion. That 1.4 billion people paid only 26 million visits to Hong Kong. This is so unbalanced, right? And what are all these Hong Kong people doing in China? That is the graph on the left, on the right, telling you they are going to Sam's Club in China. How ironic is that? We are all talking about the China-US tension, right? So Hong Kong residents are crossing border to mainland China to visit US supermarkets. Why? Because grocery is so much cheaper there. And that is the real life evidence of China exporting deflation. Jabir is having the view that that trend is not going to last for too long. I argue that some part of the deflation export that China is engaged in today might have a lasting impact on some of the peripheral markets, particularly the relatively small economies. Thank you. That's my session.
Thank you, Theo, and thank you very much to Jabir as well. I've been monitoring a couple of things. One, I've been monitoring the Q&A bar on the side of the team's screen, and I haven't seen any questions come in as yet. But aligned to that is monitoring the attendees on the call, which just hasn't changed at all. We've seen a couple of people obviously dropping a connection and coming back in, but that speaks volumes for the interest that you've generated, both of you. And we really do look forward to holding these on a quarterly basis, and we're going to be following these up as well with some more detailed webinars on how the investment team at Skybound Capital is responding to the sort of macroeconomic conditions and the themes that Jabir and Theo have been referring to. So perhaps just a final comment, Jabir, from you. We're running a little over time, but no one has dropped off yet. So thanks to you both. I think illuminating, fascinating. And I think, again, if one thing is certain, it's that when we reconvene in 3 months' time, we might well have some different views on certain things.
Yeah, I think, look, what I'm seeing, and Theo made a really interesting point about, human behavior. This is really what it's all about. And when I look at the way things are played out, leaving aside geopolitics, to me, there was no surprise in terms of how markets have played out, especially since the ending of COVID. And we're at a point now in the world economy where, frankly, we've got upside to play for. I think we've pretty much washed out the main downside news. Of course, that can still be derailed, but I do see the next step now being the other regions of the globe starting to pick up, and the impact that has on inflation and subsequently rates is going to be very, very telling. We're not over the volatility story yet. There's another bout coming. It's just trying to understand, what shape and form that's going to be.
Every reason to stay connected and stay tuned. And what we would encourage you to do, please, if you've enjoyed this session, share it with friends and family. We're trying to encourage as many people to attend these sessions as we can. And if you do have questions arising out of the topics covered during today's webinar, feel free to send them on to us. And Jabir, Theo, or other members of our team would be delighted to stay in touch. But once again, to everyone who's been in attendance and has stayed focused on the two presentations, thank you very much indeed. We appreciate your attendance and your support, and look forward to catching up with you all soon. Thanks very much once again to both Theo and Jabir, and to our whole team, to Ross for putting the technicals together, and to Bridget for her assistance with putting this webinar together. And until next time, cheerio everybody, and have a wonderful week further. Thanks.
Thank you.